Right now, April 7th, 2026, gold is sitting at $4,686, silver at $72.87. You wake up, check your screen, and boom, both are red this morning. If you've been stacking physical metal for years, you're probably staring at your phone right now, feeling that familiar knot form in your stomach. You're asking yourself the exact question the system wants you to ask: why isn't it going up? Because, let's be honest, the setup is literally perfect. Oil just cracked $100 a barrel. The Strait of Hormuz, the absolute choke point that funnels roughly a fifth of the planet's daily crude supply, went from 150 ships a day to 5. 5 vessels, that's not a supply chain disruption, that's a shutdown. Gas is back at $4 a gallon for the first time since 2022, and it's climbing with zero chill. Trucking companies aren't just struggling, they're filing for bankruptcy in clusters. Airlines have stopped pretending the economy is fine and are hiking every fee they can touch. Bags, seats, probably breathing next because the cost structure underneath them is breaking apart. And you, the consumer, are the crumple zone absorbing the impact. And right in the middle of all this, just days ago, Jerome Powell steps up to a podium and says, with a totally straight face, that the inflation outlook is in check. And no rate action is needed. Sit with that for a second. $100 oil, global shipping at 3% capacity, consumer prices visibly accelerating. And the Fed chairman is basically doing the "this is fine" dog meme on national television. This is exactly where your training kicks in. The financial training you never signed up for, but absorbed anyway from years of watching tickers and scrolling financial media. That training whispers to you, hey, if the Fed says inflation is contained, maybe it is. Maybe the oil shock is temporary. Maybe gold sitting flat while the world burns just means the market is being rational. Listen to me carefully. The training is a lie. And it's the most expensive lie you'll ever buy into. It's designed to keep you watching the wrong numbers. The price you see on your screen when you check gold or silver is not a measurement of what those metals are actually worth. It's simply a measurement of what paper contracts tied to those metals traded for in the last 24 hours. Futures desks, algos, macro hedge funds moving money around. Because the dollar index twitched, they set the price you wake up to. Spoiler alert, none of them own an ounce of gold. Most of them have never even held a silver bar. They own derivatives. They care about capturing a spread on a 48-hour trade. You care about preserving your purchasing power over a 10-year horizon, so when they all dump paper contracts because Powell blinked, the screen flashes red. And you feel doubt, but that doubt isn't an accident, it's manufactured. The paper market is functioning exactly as designed to make you feel uncertain. Right when the structural foundation underneath you is the strongest it's been in over a decade. So let's tune out the paper noise and look at the actual architecture of what's happening. Right now, 3 separate technical signals have just converged. We haven't seen this specific formation in over 10 years. And the last time it showed up, the move that followed didn't just inch up, it melted faces. Let's talk about the floor. Gold found its absolute floor at exactly $4,100 an ounce. That's not a random number. Late last year, $4,100 was the ceiling nobody could break. Sellers defended that level for months, and now those same sellers have become buyers at that identical price, old resistance converting into new support. In technical analysis, that's as close to the law of gravity as you get. The market tested $4,100, held and bounced. That single data point tells you the bull run of the last 3 years isn't exhausted, it's reloading. Now look at the geometry. We are sitting inside a massive ascending triangle on the daily chart. You've got a flat ceiling at $4,600 and a rising floor of higher lows pressing up like a coiled spring. When this breaks, the math, just taking the width of the pattern, projects a near-term target of $5,000 to $5,100. The weekly projection, $5,400 to $5,600, and the long-term monthly arc, $7,400 per ounce, but price targets are just hopium without momentum, right? Well, the weekly relative strength index on gold just bounced off 30. That is the exact boundary of deep, deep oversold territory. The stochastics are curling up from multi-year lows. The MACD is flashing the most extreme oversold condition in recent memory. 3 momentum tools screaming the exact same signal at the exact same time, but here's where it gets crazy. It's not just gold. The Dow Jones, gold itself, and GDX, the ETF for the biggest gold miners on Earth, are all sitting at major support right now. All 3 are deeply oversold. Traders call this a trifecta signal, the historical record of what happens after a precious metals trifecta. Isn't a coin flip, it's a compressed spring, and the deeper the compression, the more violent the release. If you are sitting in cash or generic paper assets right now, this next dynamic should make you very uncomfortable. The paper market is showing red today, but what is the physical market doing? Central banks are buying gold at a pace we haven't seen in decades. Industrial manufacturers are executing physical silver contracts negotiated years in advance. And what's actually happening is this: the paper sellers are accidentally creating a massive discount. And the physical whales are backing up the truck to exploit it. The paper market creates the opportunity. The physical market exploits it. And this brings us to the ultimate wealth divide in this space. Who owns the ETF and who owns the mine? Think about it. If you own a paper gold ETF and gold goes up 60%, your fund goes up maybe 50% after management fees and futures roll costs, you feel like a genius. But what about the institution that owns the gold mine? A miner's costs, diesel, labor, site maintenance, are largely fixed. They negotiated those contracts years ago. So when the price of gold spikes, their profit margin doesn't just inch up 10%, it doubles, it triples. Historically, if gold moves 50%, quality miners go up 150% to 200%. GDX just tested $80 at the exact same time. Gold tested $4,100. The technical target for the miners from this base is $130 to $150. That's a 75% gain just to hit the conservative near-term target. Retail investors get the one-to-one paper exposure and pay fees for the privilege. Institutions buy the mine, get 3x leverage, and the asset literally pays them to hold it. It's a ruthless sorting machine. One group rents a price. The other group owns a machine that manufactures margin expansion. You understand the trap now. You see the macro setup. But here's the brutal truth. None of this matters if you sit in the exact same chair tomorrow morning and open your brokerage app with the exact same mindset you had 6 months ago. Knowledge without a physical change in your routine is just entertainment. And entertainment doesn't compound wealth, so I'm going to give you a habit. It takes 40 seconds a week. It sounds ridiculously simple, almost insulting, and that is exactly why it works. Every Friday at market close, open a blank note on your phone. Not a spreadsheet, just the Notes app. Write down 2 numbers, the closing price of gold and the yield on the 10-year treasury. That's it. Don't analyze it, don't trade on it, just write them down and close the app. Do this for 6 weeks. What happens? You start seeing the real-time decoupling with your own eyes. You'll see the yield drop, gold surge, and realize the market is pricing in a trapped Fed before CNN even writes the headline. You aren't reading my theory. You're building your own sensory proof. Want to level up? Add a third column, a one-word summary of the loudest news headline that week. Tariffs, war, recession. After 2 months, you'll look at that note and realize the headlines contradict each other and change every 5 minutes. But gold, it just steadily responds to the $36 trillion in debt, and the dying fiat system, this little Friday log, is your anchor. It takes the decision-making away from your emotional brain and hands it to your logical observation. It's the armor that keeps you from panic selling the next time the market drops on a random Thursday. Let's bring it all home. You have the full architecture now, the debt ceiling compressing the Fed, the hidden inflation, the trifecta technical signal, the $7,400 long-term gold target, and silver sitting at a 60-to-1 ratio against gold, practically begging for a violent mean reversion catch-up. But listen to me, none of these targets mean a damn thing if you get wiped out before we get there. Survival is the only metric that matters. First, define your absolute floor. What is the maximum drawdown you can take before real life forces you to sell? I don't mean your emotional tolerance, I mean your bank account's tolerance. If a 30% pullback in paper price means you can't pay rent, you've already lost the trade. In 2008, gold dropped 28% before it skyrocketed to $1,900. Pullbacks are a feature of secular bull markets, not a bug. Second, keep a 6-month cash buffer completely outside of your metals trade. That buffer isn't an investment. It's buying you the one thing you need for a macro thesis to play out. Time. Being right, but going broke before the market proves you right is a tragedy caused by bad position sizing. Finally, build your exit architecture right now. If gold hits $5,100, taking 20% off the table isn't having weak hands, it's called being a professional. It converts a correct thesis into realized purchasing power while letting the rest run on a trailing stop. I'm not promising you $7,400 gold or $245 oil. I'm giving you the measured mathematical probabilities based on decades of pattern resolution. A promise tells you to stop thinking. A target tells you where to watch. I am asking you to keep watching. Track your Friday numbers. Ignore the daily paper noise. Survive the pullbacks. The people who capture generational wealth in this cycle won't be the ones with the loudest bravado. They'll be the ones who structure their positioning logically, read the physical data, and let the math do the heavy lifting.